kind of get things started, right?
Perfect. Can you see my screen?
Yeah, I think we can. And I'll share my screen after you. Yeah, this is fantastic. Can you hear me all right, Braden?
Yes, I can hear you.
Fantastic. That's beautiful. So I'm going to go ahead and share my screen. I'm going to wait about one more minute. I think the numbers have doubled since like in the last 2 minutes. So I'm going to wait one more minute for the straddlers, and we'll get started here. But in the meantime, I will go ahead and get the screen shared. Braden, you can see that just fine?
Yes, sir. Thank you.
Fantastic. Beautiful, beautiful. Good. Awesome. Welcome, everybody. I think we are at 5:05. We may as well just get started. The folks that are running a little behind can always join us and ask questions. I am Dr. Julius Oni, CEO and co-founder at XSITE Capital. And it is more than my pleasure to be here with you again today to present one of these webinars with to you, our community of investors. We are particularly excited about this particular deal. With me today and co-hosting with me, 3 members of the team. My 2 co-founders, Mr. Tenny Tolofari, and Mr. Leslie Awesome, and our fantastic investor relations associate, Mr. Braden Hyde. So all 4 of us are going to be co-hosting today and managing this webinar. My hope is to get you out of here within the hour, particularly also because we have our meetup coming up right after this. So feel free to join us for the meetup also, because we're probably going to present this deal during the meetup also. So, but let's dive right in. This deal is the Mountain Vista apartments in Stone Mountain, Georgia, which is in the Atlanta Metro Statistical Area, the MSA. It's a 144 unit property right in the heart of Stone Mountain, Georgia. Just about 20 minutes north of or 17 miles north of the Atlanta, Georgia downtown. In this particular talk, we just going to go over the investment memo or the investment deck, and we'll go through all of these things. My goal is to be done with the presentation, hopefully within the next 30 minutes, so that we can leave ample time for the I'm sure fantastic questions that are going to come from all of the people attending the webinar today. And just a little bit of a disclaimer, this business plan is for informational purposes only. Please make sure that you are double checking everything that I say, that we say, and that you are following up with your financial professional to make sure that this is an appropriate investment for your portfolio. Once again, this is Mountain Vista apartment homes. That's the entrance to the apartment. Just sharing a few pictures so that you could get a feel for this 1984 property that probably needs some love from what you can see from this aerial view. The pool still looks nice, but kind of bare. The sporting area right there looks a little worn out. But for the most part, it's got what we call good bones for the most part, and it's sitting on about 10 acres. This is what a renovated apartment may look like eventually in the future. Just some pictures, select pictures from Atlanta and showing the Stone Mountain, which this area is named after. A quite gorgeous area of the Atlanta Metro Statistical area, MSA. So one of the really cool things about this property is that almost all of the units are classic units. And for those people that don't know what that means, it means that almost all the units are the original units that were built back in 1984. What that means in multifamily speak is that there is a ton of opportunities for value add. There's a lot of value to be added. And as we add those value, then you can really create significant revenues from this property, increase the net operating income, and that eventually leads to a significant increase in the value of the property itself. So it presents a very unique investment opportunity, and we are getting it off market. So that is something to keep in mind. Just a little bit of a summary, executive summary here. We are getting this once again off market from an investor, a real estate mogul that owns over 20,000 units and that we have transacted with before. Actually, one of our best performing properties was bought from this same seller off market, and he saw how well we performed on that property and thought it was most appropriate to also let us go ahead and do something similar to this property. So this will be our foray into our first true introduction into the Georgia market and into the Atlanta market, and we are super excited about it. And one other thing that you're going to see come up throughout this talk is the fact that the in-place rents right now is almost about $500 lower than the comparables in the market. And that's going to keep coming up over and over and over again. And the vacancy in the area is an approximate, it's under 4%. The vast majority of the apartment complexes in this entire area has occupancy of 96% or over, and we'll show that to you also. And we'll go over the offering summary later on in the talk. The profile of the property. Once again, 1984 property. That's an aerial view on the right there. It's got about a 98% occupancy right now. We're buying it for $17.8 million, even though the real page estimate or valuation of this particular deal is over $22 million. So we are already buying this property with a lot of equity in it. And I would explain why that is important also later. This area has experienced over 91% in rent growth in the last 7 years. Once again, this property is 144 units sitting on about 10 acres. The average household income in this area, it's about $87.4 thousand. That's remarkable. And the units are large, over 1,000 square foot average unit size. Once again, some pictures. This is some of the amenities available in the community. We'll go ahead and skip that because we can all read it. And this is the unit breakdown. We have 3 bedrooms, 2 bedrooms are the vast majority of the units. About 81% of the units are 2 or 3 bedrooms, which is amenable to family and communal living. So, and the beautiful thing about that is we're going to be able to generate more on those units also compared to the 1 bedrooms. Once again, almost all the units are all in the original state, and we are planning to spend about $10,000 per unit on interior renovations. And we are anticipating that we will be able to get an estimated premium of $515 over the business plan, over the life of this business plan. And so this is really super exciting. The market average right now is much higher, at least $400 to $500 higher than what the property currently is generating. This is some of the things that we are planning to do. We definitely will modernize the pool. We'll finish out that sports court and make it look nice and desirable for our tenants and prospective tenants. And we'll also add a dog park to make it very friendly for animal lovers. Some of the other things that we will do on the exterior part of the property is to power wash and paint the sidings, make it look nice and bright and attractive to the prospective tenant, repair the gates, clean out the gutters, renovate the leasing office, but we'll talk about that, add some gutters to the leasing office, remove and trim some of the trees that need some love, improve some of the landscaping and really improve the curb appeal of the entire apartment complex. We're gonna put that outdoor fitness center in. Pickleball is the rage nowadays, so we're definitely gonna offer that. We're gonna resurface that sports court and repair the stairways and replace any corroded roofing or chimney parts. Just to kind of get a sense of where this property is. It's 17 miles from the airport, from the Atlanta airport, and about 13 miles from Midtown Atlanta, downtown Midtown Atlanta, and only about 9 miles from the educational and medical corridor of Emory. So a little bit about the market. I mean, I don't think Atlanta needs any introduction. Everybody knows that Atlanta has some of the greatest growth that any city has experienced over the last 10 years. It's got the busiest airport. It's got a fantastic, diverse city that continues to grow at a significant rate. And all of those accolades that you see on this screen are attributed to Atlanta. And year over year rent growth has been about 18%. And even though in our underwriting, we conservatively estimated that we'll be able to do year over year rent growth of about 5% in year 1. So that just tells you a little bit about our approach. One of the things that a lot of our investors continue to tell us is that one of our marquee attributes at XSITE Capital is that we are super conservative, and that's because we want to make sure that we are under promising but over delivering for our investors. So Atlanta has grown quite a bit, over 1.2 million people in the last 10 years between 2011 and 2021, and population growth over that period has been almost 27%. I'm not going to waste too much time on this. Atlanta's workforce is super diverse. It's obviously it's super competitive also with regards to real estate. And so the city continues to expand and expand from the maxed out places to places that were maybe previously less desirable, but are now becoming highly desirable. And Stone Mountain, Georgia, completely perfectly fits the bill for an area like that, where maybe in the past people weren't sure about, but now the growth that's been happening in that particular submarket has been just incredible. Once again, lots of employers love Atlanta. So what's our business plan? Once I went over some of the exterior business plan earlier, and once again, they are listed right there. Interiorly, we plan to do some vinyl plank flooring, some stainless steel appliances, put in new kitchen cabinets, and to give some of the tenants an option to either to have a washer and dryer in their units and rent them from us. And also we will completely renovate 52 units in the 24 months that we hope to do the renovations. Why just 52 units? Why not 144 units? Guess what? We have to leave some meat on the bone for the person who is going to buy it from us. We are going to do the proof of concept, show them how we can increase the value of this property significantly by adding all of this value. And then they will probably finish the renovations and still have a lot of meat on the bone for them to also grow their wealth in this particular deal, whoever ends up buying it from us. And what's the projected timeline? 24 units. After 24 months, we plan to do about 4 units per month. And we will be doing about average cost per unit is $16,000, but that's the interior plus exterior. Earlier, I talked only about the interior when I said 10,000. When you had the exterior cost also with that, average cost per unit will be about 16,000 per unit. And the premium for renovated units will be about $221. And the total value of the total cost of the value add plan is going to be a little over $2.3 million. Please feel free to drop your questions in either the chat or the Q&A, and we'll be more than happy to answer them right at the end of this. Once again, continuing with the business plan, we are having our rent growth projection be 5% in year 1, 4% in year 2, and 3% in year 3 to 5, even though the Atlanta submarket has been growing at about 18% year on year, but we are saying no, we're going to have the most conservative projections. And if it ends up growing 10%, then fantastic. Our investors get to enjoy that growth. But that's what we've done in the past, and that's how we've been able to impress our investors and gotten more and more people. Over 67% of our investors coming in on repeat deals with us for this reason. So this is going to be the business plan. We'll raise the rents to market rate, or at least close to market rate, and by upgrading their properties exterior and interior. We're buying this once again at $124,000 per door. I want you to remember that we're buying this at $124,000 per unit, because you're going to see what properties in the area have sold for over the last year alone. So we're buying this at a cap rate of 4.1%. For those people that do not know what a cap rate is, it's really like a measure of what properties in the market are selling for. That is a relatively competitive cap rate, because in that market right now, people are buying at the 3 cap, a 2 point something cap. The lower the cap rate, the more expensive the deal is. So exit cap rate, we are being conservative, and we are assuming that we are going to sell this at when the cap rate has expanded a little bit, and that the cap rate is going to be expanded by over 110 basis points. That is conservative. Typically, people say 10 basis points per year of planning to hold it. So typically we would have said maybe 4.6, but no, because we love to be conservative, we're saying, yes, we don't know what the economy is going to do. We don't know what the market is going to do. Let's assume that the cap rate is going to expand over the next 5 years that we're planning to hold this, and that we will be able to dispose it off at that cap rate, but with the goal of increasing the average effective rent to match the effective rent of the day. So our primary business plan is going to be to refinance this deal in year 3 and exit in year 5. The average annual return that we anticipate with that particular plan is between 18.5 to 20%, with an equity multiple of 1.9x to 2.2x. What that means, for those that don't know, is that if you invest $100,000, you can expect at the end of this business plan to end up with $190,000 to $220,000. And in the year 3, when we refinance this property, we expect to be able to give you back about 70% of your original capital. For those that don't understand what that is, that means that aside from the distribution that you may have enjoyed in the first 3 years of this property, which will be something between 6 to 8%, at the refinance event, you will get about, in that example of $100,000 investment, you get about $70,000 back at the refinance, and still continue to enjoy the distributions until we finally sell in year 5, and then enjoy some of the profits from that sale event also. So, and the secondary business plan, which assumes that the market continues to be hot going into the next 3 years, and that the average and that we are able to sell just after completing our business plan and updating and renovating this unit, the units in this property, then we projecting average annual return of 27 to 31%, and equity multiples of between 1.8x to 1.93x. Some people may ask, why don't you just go for the one with the highest average annual return? Why is the secondary business plan not your primary business plan? Yes, that is more attractive, but just like I said earlier, at XSITE Capital, we like to be conservative. We like to plan for all the contingencies and any potential surprises. And so we're saying that at the worst, even if the economy is not booming and some of this recession still persists up until 3 years from now, that we want to be in a place of strength and that we want to prep for that. But then if things are looking very rosy, then guess what? We'll sell and give everybody back their money and let them figure out what they want to do with it, and with the returns. So this is just a waterfall. So I want you to look at the right side of that PowerPoint first. What that shows you is that debt right here actually is on top of the capital stack, meaning the lender has to get paid first. That's always on top of the capital stack. The next people are the limited partners. Those are the equity partners, the people bringing in their cash to say, XSITE Capital, put this money to work for us. You are next, meaning you have to make your money first before we as general partners can we and all our partners on the general partnership side of this, they're active folks on this deal before they make their money. The preferred return is going to be 6%. So you can expect to have a 6%, at least a 6% return year on year when it's averaged out over the life of this business plan, in cash distributions. So usually we do quarterly payments. In that example of $100,000 investment, you can expect at least $6,000 divided into quarterly payments. And then if the property is doing better than we expect, and we are getting just excess, in rents, then guess what? Anything over 6%, we divide it 75-25 between you, the equity partners, and we, the managers. And if we impress you, and instead of an 18.51% average annual return, we're able to get you more than 20% average annual return, then anything over 20% gets divided about 50-50 between the limited partners and the managers. That's 20% average annual, that's 20% on a yearly basis on that investment that you have put in. So conservatively, we are saying that we anticipate that you will be able to get an 18.51% average annual return and IRR on this deal with a 1.9x equity multiple and an average cash and cash of 7.2%. Let's talk about the rent comparables. This was one of the most exciting part of the due diligence for us. When we went to check out this deal, it was kind of cool to, see the rent roll match the tenants and go into all the apartments and check out the roofs and the crawl spaces and check out all of the assets in this property. And we saw that it had good bones. There were no surprises. But what was most exciting was when we started going to all of the surrounding apartments and trying to shop rent. They call it secret shopping. We quickly realized that the rent in this particular property was grossly under market rents compared to everyone else. And the effective rent per square foot was by far lower than almost everyone else. This is some comparables in some of those other units. Feel free to check it out. And you can see the pictures of all these other apartments. So it's not like they are in any way superior to what we have at Stone Mountain. But I want you to really pay attention to this screen. Right there on the red dot is where Stone Mountain is, and all of these other apartments are pretty much surrounding it. But just look towards the end of the last maybe 6 of that of the listed apartment sales comparables there that was sold from maybe February 2022 to July of 2022, and look at the price per unit on those properties. From about February, 180,000 per unit, 146,000 per unit, 155,000 per unit. Remember how much we're getting ours for? 124,000 per unit. So you can see just that the fact that we were able to get this off market has really put us right in the place of advantage with this business plan. Once again, the offering summary showing an entry cap rate of 4.1%, and expense ratio of 52%. The physical occupancy as of September is 98%, which already shows that the rents in this are just below market. The debt service coverage ratio, which anything over 1.2 is fantastic, but we have 1.63. What that means, for those that don't understand, is that if the debt service coverage ratio of 1, just means that you're making enough money to cover your mortgage. You're not underwater on this. But we have such a cushion with 1.63. We feel very comfortable with that. Purchase price 17.8% again, million. We're planning to hold it for 3 to 5 years, depending on the business plan. We are raising a little over $8 million for this deal, with those projections as listed there. We're getting a bridge debt at a 70% loan to cost ratio, and with an interest rate of 4.25 and a floating rate cap, a tight cap of 1%. So the highest the interest rate can really go is about 5.25%. The interest only, we have only interest only payments for the duration of this loan, and we have a 3+1+1 which means we can renew the loan after 3 years for 2 additional years for this, and the rates are adjustable. This is how we're going to use the funds on the right. The down payment is 5.57. The closing cost is 1.645, including a 1% rate cap. Acquisition fees is 535, 680, and the value add, just like I outlined earlier, is over $2.3 million. The operating reserves is going to be $267,000, and the total raise amount, which is everything above minus the value add cost, because that is rolled into the bridge loan, is a little over $8 million, and we fully anticipate that we will oversubscribe on this because we've done a similar raise before, and thankfully we were oversubscribed on that. Just a little bit on the pro forma. I'm running a little bit out of time, so I have only a few minutes left, so I'm just going to quickly run through this. I just want you to kind of take note of the fact that our 5-year projected rents is similar to what some of the current comps are doing at this point. Just look at that. Ashland Pines already has about 1574, Polo Club 1573, and we are projecting that in 5 years that our average effective rent will be about 1549. So this is relatively conservative numbers. Break-even occupancy is about 70-some% in the first 3 years. That's amazing. That means that we could literally go down to 75% occupancy, which this property has not seen in several years, and still be fine, still be able to pay the mortgage and be fine on this particular property. We could discuss more of this pro forma later, but we'll move right on in the interest of time. And even though we have a little bit of pref deficiency in the first year, where you may, if while we're still trying to get this property renovated and set up, you may get only about 5% in your cash and cash return, but that goes right up right after that, once we have this property nice and stabilized. And this is just a sensitivity analysis. Let's assume that we end up selling at a 5.5 cap, so much worse than the 4.1 entry cap right now. We still expect to be able to generate a 1.7x equity multiple and a 17.28 average annual return on this property. But if we are lucky enough, which we anticipate we will be, for the market to continue, for the cap rate to continue to stay relatively compressed, and maybe it's 4.75. So expands a little bit, but not that much. We could still generate a 2.2x equity multiple on this deal. So a $100,000 investment will yield at least $217,000 on that particular property. So this is just a little summary of what investor returns could be on a $100,000 investment. These are what you can expect for your returns divided into quarterly payments. And then with that refinance, you get that big lump sum. And then obviously because of the refinance, the cash flow drops a little bit. And then we sell at some point in year 5, and we should be able to get that number conservatively. The management team is made up of XSITE Capital, myself, the CEO and co-founder of XSITE Capital, Tenny Tolofari, our co-founder and director of acquisitions, Leslie Awesome, and our co-founder and director of operations. We are also lucky to have an outstanding and incredible team, including Braden Hyde, our investor relations associates, Macy Price, our marketing specialist, Manny Awesome, our underwriting guru, and Miles Hill, our acquisition associates who just has boundless energy. For those that have worked with us in the past, you know us and you know how we love to communicate and we love to treat our investors just like they are family. We also have strategic partners that have been on most of our deals with us. We truly enjoy working with this two fantastic gentlemen, Chris Lento and Brad Kangiamila, super experienced real estate people who have been amazing partners to us on many of our deals. And we look forward to going on this journey again with them. First Communities Management is our property management, third-party property management company, and they've been an incredible partner to us. They help us with due diligence, with implementing the business plan, with making sure that we are achieving our metrics and our KPIs for the benefit of our investors. And we are incredibly grateful to them. They manage over 200,000 units in the US, and their leadership and everyone from top to bottom have just been incredible partners to us. Our portfolio is about $125 million in asset under management. Our most recent acquisition was Land Bank Loft, which we acquired in March 2022. The one that I was saying that reminded me of Stone Mountain is the View, which we acquired last year in April 2021. And for those of you that invested in the View, we have some fun, exciting news for you. And I'm sure that you will be hearing about that soon. But we have been very fortunate to have had the opportunity to bring our investors, all 250 of them, on all of these deals. And we look forward to taking many more of you on this journey with us. Thank you so much for spending the time to listen to us. Please drop your questions right in the chat or Q&A. Email either Braden or I about any, if you're ready to make an investment. And if you just saying, you know what, I don't need to hear anything further, I want to be one of the first people to reserve my spot, just scan that QR code right on your screen and reserve that spot for you. The minimum investment is $50,000. But as I found out quickly in our last raise, we are starting to get $500,000 checks, $250,000 checks. So we welcome it. I'm hoping that we get our first $1 million check on this particular deal. So I'm very optimistic that this is going to be a quick one for us. And that should be it for the most part. Before I open it up to questions, I would love to hear some feedback from my colleagues and my co-founders. Mr. Tenny Tolofari, what do you think about, what's the most exciting part of this deal for you? I know you did a whole lot of work to get this deal done. We went through hundreds of deals trying to penetrate the Atlanta market, and we just couldn't find the right one for us. And finally, we found it. What about this deal gets you most excited?
My chairman, Dr. Julius, what an outstanding presentation. Thank you so much for the insight you've given to our investors. I'm just going to go straight to the point. Just going by that deal, driving it, and seeing the possibilities that we and our investors will bring to the lives of the people that live in that community was one of the main things that excite me the most about this deal, because you're basically transforming lives and the way people live. So a lot of people see these investments like, oh, I want to grow my wealth, but they don't look at the impact that it creates. So for me, and XSITE Capital is that impact. Dr. Julius Oni just kind of highlights the different things we're going to be doing on this property. So imagine if you're living in this property, how in the next 12 to 24 months, the community is going to be transformed. The kids are going to have a place to play. You're going to have a nice pool. You're going to have a nice place to call home. It's going to be more secure, beautiful. So you as our investors being a part of this journey with us is basically transforming lives. So for that, we really appreciate you for being here and joining us in this journey. So Dr. Julius, that's the most exciting part for me.
That's fantastic, bro. Yeah, definitely. We're gonna change this from a ugly duckling to a beautiful, beautiful prince or princess, whichever one you want to call it. Yeah. So Leslie, I'm curious as to what what excites you about this particular deal.
Dr. Oni, again, thank you for a great presentation. I think Tenny highlighted some great points there as well, but being on the number side of things and always looking for a number to turn a deal down that Tenny brings to the table. When we went and did the rent comps, I was totally blown away by the potential that this deal has, and how we have not even incorporated a lot of that potential in the underwriting that we have. This property certainly has a ton of meat on the bone, like we commonly say. So for me, that's the most exciting part. The opportunity for growth as we take over this asset is tremendous. And it's going to be an exciting one to have our investors along with us on this journey. Thank you.
Yeah, thanks. Yeah, and we'll just open it right up to questions at this point. But for me, what excites me most about this deal is it gives me that same feeling I got with the View, which is essentially our best performing asset at this point. Actually, what Land Bank lost to is, I think they're like neck and neck. But our last two acquisitions has been close to home runs, and this just gives me the same feeling, but on a larger scale, because at least the View had like, I think almost 50% already done or more. And this is like nothing done. We literally could add as much value as we need to, and we're already going in on a superior basis. So, but yeah, what questions do we have so far? Let's see. Oh, somebody was asking, how does the average income in the area affect the proposed rent increases? Thanks for that fantastic question, Dwayne Johnson. I'll let Leslie answer that.
Thanks, Julius. So the average income right there now, Dwayne, is $87,400, and based on our projected exit rent of average of about $1,500, we're still way below the 33% that is recommended of the monthly income that goes towards rent. So my underwriting is very, very conservative. The rents that we're projecting to exit at year 5 are way below our affordability for this particular submarket. So and even if we look at the median income, it still falls below that 33%. So they will definitely have the demographic in that area to afford the rents that we're projecting, for sure.
That is great. What is the tax advantage to us as a first-time investor? I love talking about this, yeah, because this blew my mind when I first learned about it as a multifamily investor. So for every investor, we're going to do a cost segregation study on this particular deal. A cost segregation study is when we take a company, a cost segregation company, they bring the accountants, the engineer, and they depreciate everything on this property besides the land and the building. And they literally typically give us depreciation of anything between 60 to 80% of the value of the property. So if you invested $100,000, you may end up with depreciation of between $60,000 and $80,000 that you could use to offset any other passive income that you may have. Meaning any passive income coming from rents, any passive income from anything that you've invested in the business. However, it gets better. If you are lucky enough to have a spouse who is a real estate professional, or you yourself have achieved the real estate professional status. For people who have never heard of that, write it down, rep status, REPS status. Because when you or your spouse have achieved that, rep status, which just means that you materially participate in real estate, 750 hours. You don't need to necessarily get a certificate to achieve rep status. You just materially participating, actively participating in real estate management for 750 hours a year. You can actually now use that depreciation you got from this property to offset your W-2, your 1099, your earned income. It's a powerful strategy. So The first time, as a first time investor, yes, I think it's the tax advantages are tremendous. And for those of you that do end up investing on this with us, we will be issuing a Schedule K1 to you at during tax time, and it would state it right there what your depreciation is, and you will be able to take it to your CPA and apply it to your taxes. And also, for people always ask, do I always have to invest with cash? No, you can also invest with your self-directed IRA or retirement accounts. That is completely okay. The only difference is that with your self-directed retirement accounts, you made, obviously your retirement account is the entity investing, so you cannot take advantage of this, paper losses, the depreciation that we're talking about. Oladapo Firebear asks, is the investment a one-time payment or can it be spread over some time? It's a one-time payment. The minimum investment is $50,000 and you have to be an accredited investor to invest. Being an accredited investor just means that you earn at least $200,000 a year as an individual or $300,000 with your spouse. Or it's one or the other, or you could be worth at least $1 million in net worth. Is one of those three things. So if you earn at least $200,000 as an individual, then you're an accredited investor. If you don't earn if you earn only $150,000, but your spouse also earns $150,000 combined, that's $300,000. Yeah, you guys are still accredited investors too. So, yeah. Any other questions?
Julius, can you add about the resource we have for helping check accreditation status?
Absolutely. I mean, we pay for you to have your accreditation status actually checked by a third party so that we're not double checking that for you. You actually could just go to your CPA and just have them write you a letter saying I'm accredited, or you could just go to Early IQ. Is that what we're still using on this one? Which is our third party
parallel markets.
Which one? Parallel markets?
Yes.
Fantastic. So we're going to use a third party accreditor who is just going to look at your W-2s and things like that and send us a note saying, yes, this person is accredited, they're ready to go. Any other questions? Any questions in the chat? Awesome. It seems like people are just so let's see. Let me see if Kudip says it seems like a great opportunity and exciting. I couldn't agree with you more, Mr. Goyo. Absolutely. I think that's all I see right now. Any other questions here? And what time is it? We have 10 minutes to spare before we have to jump over to the meetup. Yeah.
So if I may add, Dr. Oni,
yeah,
so
please
the
go.
subscription documents will be available by this weekend for this opportunity. And you could review the documents for everybody that's interested, and then you could submit your funding. All the information will be available to our investor portal. For everybody that signs up, you'll be hearing from us. We'll be following up with you on the steps to take to move forward with your investment. And feel free to reach out to any one of us if you have any questions about anything.
Absolutely. Yep. I think this is going to be a super exciting one. For those that like have not done this before, we are more than happy to walk you step by step through the process. I know Braden cannot wait to do that. I certainly cannot wait to do that too.
Right.
But certainly it's an exciting time, and the fact that we are taking the people in our community with us to do this, people in our professional communities and our daily lives with us to do this, just makes me so happy and brings a lot of joy to my heart. So this one is a particularly great opportunity, and in true XSITE fashion, we've conservatively underwritten it, and all of us are going to be certainly investing pretty pretty significantly in this because we always co-invest with our investors, but also because we want to grow our wealth too. So, Braden, any last words? What are your thoughts about this one?
Like Julia said, I'm very excited to, get to know a few more of you and, work with the people that we already have establishing relationships with. I couldn't be more excited about where this property is located and how much value add potential there is with this one. And just to quickly encapsulate, I don't know if you saw the pro forma, we have 5 years to bring rents up to where the current properties are that were built around the same time as this one, right? So it's a very conservative play. I could talk about it all day. And on the slide before, this whole presentation will be available. So on the slide before is my contact information if you want to schedule a call with me. And if not, like I said, we look forward to getting to know you, and we'll be sending out more information about the deal in the days and weeks to come.
Yeah. I think Dr. Marshall was asking what's the expected date to finalize the deal. And I think, Braden, you may have said October 30. I think that is going to be too late. I wouldn't want people thinking.
Leslie, we came up with a timeline today, right?
Yeah, I think that's going to be way too late because I would anticipate that by the end of September, that this is going to be completely filled up and people wouldn't be able to get in. So it's better if you think that this is going to be the deal for you. At least in our previous experience, what's happened is in the first 30 to 45 days, the deal is completely done. So, yep.
So I just received an email in our mailbox, and somebody was asking how is the school system in the area?
The school system in the area. Leslie, you want to take that?
Yeah, the school. I think the schools are rated about 4 to 6. The area is transitioning right now. It doesn't have the best schools in Georgia, but it's going there. It's transitioning right now. You're having a lot of people. One of the great things that this play presents, especially in this time of the economic cycle, is like with rents going like tremendously crazy in main town Atlanta. People are moving now out to the suburbs, and we're starting to see that now in Stone Mountain. Although the rents are right now average about $1,500-$1,600 in most of the properties, that is still way below what they're seeing in comparable properties in Atlanta. So that's one of the things that makes this such an attractive investment. And as the area transitions, so the school district is going to improve. Right now, the schools are rated around 4 to 6, depending on the school, on the level that we're looking at.
Yeah, I think this area presents a great opportunity for people to still have relatively affordable living compared to like living in downtown Atlanta, and it still gives direct access to Atlanta, to downtown Atlanta. I think Jifa raised his hand, and please go ahead and unmute yourself and speak, Jifa. Dr. Lotso, my very dear friend. Can you please give Jifa Lotso an ability to speak, please? Braden? Oh, there we go.
Yep.
Jifa, you can just unmute yourself. I think you're still muted, brother. There you go.
Yeah. How about now?
Yeah, we can hear you now. Yep.
Perfect. How you guys doing?
We're doing quite fantastic.
No, perfect. So forgive me, I probably may have missed some questions in parts of the presentation. I've been back and forth trying to multitasking patients, but I just wanted to just thank you guys for this, presentation and bringing this opportunity to us again. I'm pretty excited about it. But one of my questions is really about, the tax sort of, some of the tax implications after the year 5. So let's say after 5 years of holding, let's say 100,000 into this deal, what sort of tax breaks or implications do we have after that year 5? I really wanted to understand that more.
Yeah, so I'll start and I'll let either Tenny or Leslie kind of polish it off. So thanks for those comments, Jifa. So yes, you do the depreciation that you get on these deals is essentially a tax deferment. Upon sale of the property, there's a little bit of a depreciation capture or recapture, if you want to call it that. And you still pay capital gains taxes on the sale, upon sale of the property, on whatever your returns are. However, one of the ways that I've been able to offset that is to invest in the same year in another syndication or in another property that's going to give me just as much depreciation. So it's literally just carrying over. So yes, I'm supposed to pay taxes on what I just made, but then I have more depreciation, and this is still a passive income, right?
Right.
So it's one of those things where if you just continue to just do it, where as you're exiting, you're also investing in some other asset class that allows for significant depreciation, you'll be able to offset those taxes.
Okay.
But obviously, that comes with a caveat that the only thing I'm licensed to do is to replace hips and knees. And so I'm not a financial professional, neither am I a CPA. So please check with your financial professionals, my brother.
No, because I get that question all the time.
Got it.
The tax implications after, the 5 years or the 7 years, whatever the deal, sort of out to be.
You're still not paying earned income taxes on it. So it's not still 40% or 30-something%. It's capital gains tax, which is, what, 20% or something like that?
20%,
right?
Long-term.
Yeah, exactly. And then if you still don't want to pay that, just invest in another deal and get more depreciation from that deal. And then that offsets that taxes.
Okay. And there's no short gains or short-term sort of capital gains on the annualized or the annual returns that come quarterly?
Oh, you're talking about, so you already offset those with the depreciation.
That's right.
From the deal. Yeah.
From the deal, right.
Yep. Got it?
Oh, I'm good.
Awesome. Thank you. Well, with that, I think I'm going to call it. Because
before you call it, Dr. Oni, there was one question from Patrick Ora about the returns.
Oh,
that is correct. It's a 1.9x multiple, which means over the 5 years, your gains that you're going to get from the cash flow and the appreciation is going to be about 90,000. So you get your initial $100,000 back plus 90,000 total in returns over 5 years. That is if we hold for 5 years.
Yeah, and that is with the most conservative estimate. I want you to keep that in mind. Anyways, with that, I want to say thank you to you all for joining us. You could be anywhere else in the world, but you're here right here with us. That means a lot to us. We don't take it for granted. And we hope that you would join us on this journey to taking this beautiful property from what it is currently to maximizing its great potential, not just for the tenants in this property, but also for you, our investors. So look forward to seeing you on the deal. We welcome any additional questions. Thank you and God bless.
Thank you, everybody.